the global economic landscape is heading toward a profound transformation. This shift will not just alter the way financial systems operate, but will fundamentally reshape the existence that people in many countries have become accustomed to. A new era appears to be on the horizon, and its implications extend far beyond what many currently anticipate. Since the conclusion of World War I, the global economy has been dominated by a single Tier 1 reserve asset class: U.S. dollars and U.S. treasuries. These have long been regarded as riskless assets by central banks worldwide. However, a groundbreaking development occurred quietly but decisively when the Bank for International Settlements, BIS often referred to as the Central Bank of Central Banks, reclassified gold as a Tier 1 reserve asset. Let me emphasize this critical point. Gold is now the only other Tier 1 reserve asset globally, standing shoulder to shoulder with the U.S. dollar and treasuries. This decision was not a mere technical adjustment. It was a signal of seismic changes ahead. To fully grasp the significance of this move, let us examine the 3 years leading up to the BIS reclassification. Consider the actions of several prominent central banks during this period. Germany's Bundesbank repatriated vast amounts of gold. Similar repatriation activities were seen in countries like Austria, Hungary, Poland, and Czechoslovakia, among others. Central banks across Eastern Europe not only reclaimed their gold reserves, but also embarked on a massive gold buying spree. These actions seem too coordinated to be mere coincidences. A more plausible explanation is that the BIS discreetly informed its member banks about the forthcoming changes, urging them to prepare by consolidating and increasing their gold holdings. This advice likely included the strategic repatriation of gold stored abroad, ensuring it was under their direct control when the new financial framework came into play. Fast forward to 2020, and we witnessed a continuation of these trends with even greater intensity. Central banks across the globe accelerated their accumulation of gold, signaling that gold's role in the international monetary system was becoming increasingly central. But this was not the only noteworthy development. The International Monetary Fund, IMF, an institution created during the historic Bretton Woods Conference at the end of World War II, began to advocate for a new Bretton Woods. For context, Bretton Woods was the birthplace of the current global financial order, which established the U.S. dollar as the world's reserve currency, pegged gold to the dollar at a fixed rate of $35 per ounce, and classified dollars and treasuries as Tier 1 assets. The IMF's call for a new Bretton Woods, some 80 years later, was a stark acknowledgement that the existing system was no longer sustainable. The IMF's proposal for a new financial framework coincided with other intriguing developments. One of the most significant was the emergence of a mysterious group of traders on the commodity exchange, COMEX. To understand the importance of this, we need to delve into how the COMEX operates. The COMEX, part of the Chicago Mercantile Exchange, is the world's primary market for trading gold, silver, and other commodities. Each week, it publishes a Commitment of Traders (COT) report, which details the positions of the largest players in the market. Historically, these players fell into two main categories: commercial banks, which include entities like JP Morgan and Citibank, and speculative traders, such as hedge funds and investment managers. However, in 2020, a third category of traders appeared on the COT report. This group, labeled the Others, is believed to represent sovereign wealth funds and family offices. These entities are among the most well-funded, well-informed, and influential private traders in the world. Their emergence on the COMEX was unprecedented, and their actions spoke volumes. They began systematically draining the COMEX of physical gold and silver, transforming an exchange that was primarily used for speculative trading into a mechanism for physical delivery. This trend was unparalleled in the history of the COMEX. In 1 year alone, the others removed more silver from the exchange than had been withdrawn in the previous decade combined. Similarly, their gold acquisitions rivaled the official reserves of major central banks, such as the Bank of Japan. The timing of these developments raises compelling questions. Why did the others begin their activities in 2020, just a few years after the BIS reclassified gold? Why did central banks accelerate their gold purchases and repatriation efforts during the same period? And why did the IMF, an institution deeply entrenched in the existing monetary order, suddenly call for a new system? These events are not isolated. They are interconnected pieces of a much larger puzzle. The common thread running through them is gold's re-emergence as a central pillar of the global financial system. Adding another layer of complexity to this evolving narrative is the rise of central bank digital currencies, CBDCs. Many experts believe that these digital currencies will ultimately be pegged to gold, leveraging its status as a Tier 1 asset to instill trust and stability. The question then arises, why are central banks and influential private entities accumulating gold at an unprecedented pace? The answer likely lies in the recognition that gold will play a pivotal role in the new financial order. The actions of central banks, the others, and the IMF suggest a coordinated shift toward a gold-backed monetary system, possibly facilitated by CBDCs. As these trends unfolded in the financial realm, another monumental initiative was taking shape: China's Belt and Road Initiative, BRI. Often described as the most ambitious infrastructure project in human history, the BRI aims to connect Asia, Africa, Europe, and parts of South America through an extensive network of roads, railways, ports, and digital infrastructure. By 2020, the BRI encompassed over 70% of the world's population and nearly half of global GDP. Its scale and scope are staggering, and its implications for the global economy are profound. The BRI's significance extends beyond physical infrastructure. It is also fostering deeper economic integration among participating countries, many of which are seeking alternatives to the U.S.-led financial system. This trend is evident in the growing demand for gold and silver within the BRI framework. Silver, in particular, is critical for the digital and green technologies underpinning the BRI's infrastructure. The demand for these metals is expected to soar as the BRI progresses, further reinforcing their strategic importance. By 2021, the momentum toward a new economic order became even more apparent. Countries like Russia, Turkey, India, Poland, and Brazil intensified their gold acquisitions. Even traditionally conservative central banks, such as those in Hungary and Thailand, joined the gold-buying frenzy. The actions of these nations indicate a clear strategy: diversify away from U.S. dollar assets and prepare for a multipolar financial system. The weaponization of the U.S. dollar in recent years has only accelerated this shift. When the U.S. imposed financial sanctions on countries like Russia, it inadvertently incentivized other nations to reduce their reliance on the dollar. China's consistent reduction of its U.S. Treasury holdings, amounting to $150 billion over 8 months, is a case in point. Similarly, Japan, Saudi Arabia, and other major holders of U.S. treasuries have scaled back their investments. The overarching message is clear: these countries are seeking alternatives to the dollar-dominated system.